So what do you need to know about your cash at your bank? We're going to give you some things to think about, things to consider when it comes to having cash at banks. Seems like an appropriate topic given the headlines over the course of the past couple of weeks. Also, we're going to talk, or I guess maybe touch base again, on ESG investing, Biden's first veto, and how those two come together to make it more important than ever to roll over your employer plan, be it a 401k, 403b, to roll the balances in those plans over to an IRA at the earliest possible option. Welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, also coming to you on a host of other podcast platforms, be it Spotify, Apple, iTunes, or even our videos over on our YouTube channel. Make sure you connect to us either directly through those particular platforms or go to our website, nelsonfinancialplanning.com. You'll see a bunch of icons. Click on the one that looks most familiar and you'll get immediately connected over to our channels. Make sure you subscribe so that when we reference sort of prior topics on prior shows, you can easily find and cross-reference what we're talking about on today's show, for example. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So, another week, another Federal Reserve rate increase. The 9th straight one this past week in 12 months, cumulatively totaling now darn near 5 full percentage points. Fortunately, they did drop the language that they issue, or they didn't drop some of the language that gets issued out when they announce a rate increase. Specifically, they eliminated the words ongoing increases. So that leads to some speculation that perhaps they may be done, maybe another quarter point at the next meeting, but effectively it's about darn time, in our opinion, that they pause and give these rate increases time to get into the economic soup, because it does take 6 to 9 months for these rate increases to actually show up and have an economic impact. So if you've been raising rates at lightning speed over the past 12 months, well then about half of those, or probably well over half of those, still haven't made it into the economic soup. So perhaps it's time to sit back and let the soup simmer and maybe taste it a little bit to make sure that it's not getting too gross, for lack of a better description. Clearly, the bank headlines have caught the attention of the feds because one could say, and I will say it, that the feds are in fact responsible for what's going on with the banks. They are sort of behind the scenes as to what's driving the concern over banks. How is it that banks kind of are impacted by the Federal Reserve and what's going on? Well, you have to take a step back and understand sort of how a bank works, right? So they typically take your money. Well, they don't take it. You deposit it with them. I mean, after all, they're not stealing it. And so you deposit it with them, and then they take that money and they invest it. And typically that's in a relatively conservative portfolio, a highly liquid investments, things like that. Because at the end of the day, if people need cash, then the bank needs to liquidate its investment portfolio or part of the investment portfolio to meet those cash needs. That's kind of how the world works as it relates to banks. So, of course, one of those investments, or probably the biggest investment that you might see inside of a banking investment portfolio, is something known as the U.S. Treasury. It's often considered the gold standard, if you will, in terms of investments. A shorter-term U.S. Treasury issued by the United States government, generally considered in financial parlance as a riskless, or the risk-free rate of return is what you get on a U.S. Treasury. And of course, if you buy a Treasury when it is issued and you hold it to maturity, you're not actually going to lose any money so long as the U.S. government exists. That's how a bond, or any kind of bond, doesn't have to be a U.S. Treasury, but that's how a bond works, right? If I buy a bond when it is issued and I hold it to maturity, well, then that face value, the coupon is, of course, the interest that you get, but the face value of the bond, that's what's coming back to you. That's the amount of money that you put in, and then that's the amount of money that you get back at maturity, assuming that the business or the government that issued that bond is still a viable business or government. So that's kind of how it works. The key statement in that is that there's never going to be an issue in theory, there's never going to be an issue if you hold your Treasury or your bond all the way to maturity. So in the example of an investment portfolio that a bank might have, those maturities are usually relatively short. They're not 30 years out. They're usually much shorter term T-bills and shorter term treasuries and things like that. But if you're a bank and your depositors decide, hey, wait a minute, we think we might need some cash, and you don't have enough cash on hand, and you have to go and sell some of your treasuries to generate cash to give to your depositors, well, then you're not able to hold that treasury to maturity now, are you? You've got to sell it, and you've got to sell it in the open market. See, there's also a bond market, just like there is a stock market. And now that you're in the bond market, now it's a call as to how much someone else is willing to pay that, because the other party to the transaction is not the U.S. government like it would be if you held it to maturity. It is, in fact, whatever third party is willing to purchase that bond at whatever the price is that the bond market is saying that the price is. Well, if interest rates have gone up, guess what's happened to that price of that bond? It has gone down. So who's risen interest rates as dramatically as it has? Well, the Federal Reserve. So you quickly see the problem when it comes to banks, and the typical investment you would see inside of a banking investment portfolio would be these treasuries. Federal Reserve proceeds to raise rates 9 times straight over a 12-month period of time, and ultimately you impact the pricing of those bonds. So as a bank, right, then I'm going to suffer a loss on my investment portfolio because I have to sell my treasuries early, not at maturity. So if the bank suffers a loss on the investment portfolio and still has to give the depositors cash, you can see where things quickly get out of control. And that's how all of this is connected. So we're going to take a break and continue this conversation here on Dollars and Cents. So stay tuned here on News Radio, WFLA Orlando. These days, and it's certainly one that we delved into in great detail last week during our most recent Nelson Financial Planning quarterly client educational meeting. As you know, if you're a client of the firm at Nelson Financial Planning, and unfortunately if you're not, well, then you don't get an opportunity to go to educational events like this. So we would ask, well, if you're not, why not? At the end of the day, you're probably overpaying for underperforming results. So why not come give us a chat? That's a side commercial. We'll come back to the topic at hand. Anyway, we thought it important enough to spend a lot of time during that educational session to really talk a lot about some perspective on what exactly is going on with the banks and the questions, more importantly, that you should be asking yourself right now, particularly relating to if you've got cash in a bank, credit union, whatever the case may be, and what should be some things that you ask yourself, or maybe some things that you investigate in, particularly if you've got cash in a bank. So here we go in terms of those comments, because certainly we gave a lot of perspective. And we start with the notion that banks are businesses too. Banks aren't some lofty pedestal type of sector of the economy. They're an important part of the sector, don't get me wrong. But for some reason, I think sometimes we kind of don't think they'll act and operate like other businesses. But the reality is that they most certainly do. They're not immune to poor leadership. They're not immune to bad business decisions. And they're not, at the end of the day, not fundamentally different than retail or a restaurant or whatever the case may be, right? And so at the end of the day, bank failures, or simply banks going out of business, is part of the normal economic climate. Just as recessions are, if you're keeping score over the past 250 years, there's been 48 recessions. People ask me, well, when will the next recession be? And the answer is, I don't have any idea, but I know there will be one, because if there's been 48 over the last 250 years, pretty sure there'll be 50-ish over the next 250. That's how it goes. The reality is, though, that there's certainly some interesting statistics when it comes to bank failures that I think it's important to keep in mind, particularly as we start to see any kind of headlines these days about bank failures. So if you think back to the 1980s, on average, during that particular decade, there's actually a bank failure in this country on average about every 3 days. Over the course of the past 20 years, no less than 565 banks have failed. Does that sound like something that never happens? But yet at the end of the day, we seem to think that these banks are on some kind of a different pedestal, that there's some quasi-governmental thing going. They're not. These are all independent businesses. Banks are businesses too. Not immune from bad decision-making, not immune from bad investment judgment. And so at the end of the day, yes, they've got the FDIC guarantee. Yes, there's some regulatory things that they must follow, but that doesn't make them immune, or doesn't make them any different than any other fundamentally business. So, whose responsibility is it when doing business with a bank? What is your responsibility, to be more specific, when you do business with a bank? When you walk in and establish a relationship with a bank, what's your responsibility as a consumer? So you should kind of ask yourself similar questions as to, if you walked into your doctor's office or you walked into a restaurant. You'd want to make sure that the doctor was good and that the restaurant was clean. Those kinds of things are the same kinds of questions you should be asking about your bank. Not that it's the one right on the corner, so I'll just go to that one because they're all the same. I think we're seeing that they're not all the same. So are they a good bank? More importantly, how much money do I plan on having with them, right? And that's where the FDIC limit comes in. Just to clarify, the FDIC limit is $250,000 per person per account ownership. So for a typical couple, right, if they've got a joint account, that's 2 people, 1 account, there's $500,000 of coverage. If that same couple, then he's got an account, she's got an account as well, besides that joint account, well, there's the joint account was $500,000 of coverage, and then the individual account is another $250,000, and then the other person's individual account is $250,000. Very quickly, you're up to like $1 million of FDIC coverage. And as we said in our educational meeting this past week, if you're sitting with over $1 million of cash, you really probably need to come in and see somebody, because that's a tremendous amount of cash. So you can see for the average individual, the normal person, if you will, that you're just not going to get to the point where the deposits that you've got on hand are going to get well in excess of those limits. Who would be potentially susceptible to that? Well, businesses. Businesses at the end of the day typically hold larger amounts of cash, right? You got to meet payroll, things like that. Typically, a business is going to have a much larger amount of cash. So if you're a business and with that kind of cash, chances are you're a decent size business. And so typically you would have somebody that's maybe paying attention to the books and the financials. Maybe that's a certified, kind of a chief financial officer, or maybe that's a risk manager, or whoever it is. There's somebody there that has the responsibility of making sure that who you are doing business with as a business is a good business, right? Makes sense at the end of the day. So, for example, I'll just give you one example from the most recent headlines. If I am Roku, right? So Roku, that's the one that makes the little purple thing that you stick underneath the TV to get access to all the apps, right? So if I'm Roku, okay, before I put 487 million, that's right, 487 million of my cash with Silicon Valley Bank, maybe I want to check out the condition of said bank, right? But that just... Do I have a CFO, chief financial officer? Do I have a risk manager? Do I got anybody that should be in that role to protect $500 million of cash? Don't you think? And if I had done that, then one of the things that I can do, and frankly, you can do as well, if you go to the internet, in about 10 seconds, you can find the most recent, latest SEC filing for any bank, let alone Silicon Valley Bank. If I had done that, I would have seen that at year end, that bank clearly had some problems. Now, think back to what we were talking about in the first segment of this program. We were talking about the problem that these banks are having is if they have to sell their part of their investment portfolios, part of their treasuries now, well, then you can't hold that to maturity. You've got to sell it, and you've got to sell it early. And then that price that you're going to get is dependent upon whatever you can get in the bond market. If you're holding to maturity, all fine and dandy, because on the other end of that, at maturity, sits the federal government. But if you got to sell it beforehand, it ain't the federal government. It is whatever the third party is that's in the bond market that's willing to pay for that bond. So if you checked out Silicon Valley Bank at year end, about 90% of its portfolio they had held or valued at maturity rather than at present value. Your alarm bell should have been going off. Somebody should have been paying attention and ultimately thinking about, does it make sense to do business with this particular bank? So why do we care? Right? Okay, fine. So whatever. Okay. There was a clear liquidity crisis. A bunch of businesses that should have known better didn't know better or didn't do what they should have done. And so the reality is it now creates some waves. And it's not like bank failures are all that unique, right? So I guess at the end of the day, am I worried about bank failures? No, not really. I mean, there's been 565 of them over the past 20 years, so it's a normal part. But what does all of this really mean, and where should your concern be? And we're going to talk about that coming up next on the program here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So if I am not fundamentally worried about bank failures, as we kind of walked through that exercise and discussion in the prior segment of the program, at the end of the day, over the past 20 years, there's been 565 bank failures. Banks are businesses just like anything else. So if bank failures don't necessarily trouble me, but at the end of the day, businesses need to be smarter in terms of who they're doing business with, what does trouble me out of all of this? And that's what we'll talk about in this segment of the program. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars, including headlines that involve bank failures, Federal Reserve, interest rate increases, and the like. Of course, We're one of the top 25 financial planning podcasts on the World Wide Web as well. So make sure you check us out on your favorite podcast platform or even our YouTube channel. Simply go to our website, nelsonfinancialplanning.com, and you'll see icons there that will allow you to connect directly into our channels on those various platforms if you have any trouble finding us on whatever the platform is that you are on. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries as well that can help you change your life with a successful and cost-effective financial plan. So if I'm not worried about bank failures, what am I worried about? Well, I'm worried about the everybody gets a trophy mentality at the Federal Reserve. Let me say that again. The everybody gets a trophy mentality at the Federal Reserve. Now, for those of you who know me or longtime listeners of the program, you know that I have 3 boys. And when the boys were younger, they're older now, they're all in college, one's about ready to graduate, I was very involved in coaching youth sports. And so one of the things that I observed as I was coaching my kids as young kids and they were going up through the ranks is it just seemed like it used to be when I played youth sports, like the team that won at the end of the season, they were the team that got a trophy. And maybe the team that, kind of got to the championship match and lost got a trophy as well, but it was definitely like a smaller trophy, if you will. And one of the things that I observed is that everybody got a trophy of exactly the same size, same look, same feel. It didn't matter whether you had gone through the season undefeated or had lost every game, everybody gets a trophy. And so over the years, my kids' rooms were filled with trophies. We do sports on a regular basis. And it just, when you think about that, and when I would stand in my kids' room and look, and, when I was a kid, the notion of getting a trophy kind of meant something. And it sort of doesn't. And the problem with that, I think, is that it doesn't reward success. And it doesn't give an opportunity for our youth to see that. Because when you get out of the protective confines of your home or your school or whatever the case may be, the reality is people get fired all the time from their jobs because of poor performance. So maybe you want to try and do better so that doesn't happen. Well, along comes the Federal Reserve with its own version of the everybody gets a trophy mentality, because that's exactly what you've seen over the course of the past 2 weeks. The 2 bank failures that happened in both cases, the Federal Reserve almost immediately stepped in and said, that $250,000 FDIC limit, don't worry about it. We got you covered all the way up to whatever cash you had on file with the bank. Regardless of whether you didn't even bother to do your due diligence, regardless of whether you had a risk manager or a chief financial officer that should have been checking that stuff out, it's okay. We got you. This idea was furthered by Treasury Secretary Janet Yellen last week in a speech that she gave to none other than the American Bankers Association conference in Washington. It said intervention necessary. If intervention is necessary, similar actions would be warranted. So what's the problem with all that? What do you think the problem is with all that? It only encourages bad behavior. It doesn't encourage people to do well, to make good decisions, to exercise good business judgment. Because after all, remember, as we've been saying on the program, banks are businesses too. And at the end of the day, if you know that the old Federal Reserve is going to come in and ride to the rescue and you got nothing to worry about, what do you think a bank's going to do? Take a little bit more risk, try and generate a little bit more profit. And at the end of the day, what do you wind up with? Well, you wind up with more bank failures. Sort of a return to the 1980s when, on average, you had a bank fail in this country once every 3 days. Is that really the climate or the environment that we want to produce? Well, with everybody gets a trophy mentality that the Federal Reserve is exhibiting, it's exactly what you're going to have. Now, here's the other part. Here's where it really comes home. Because at the end of the day, if you don't think that you and I and the rest of the American consumer isn't going to foot that bill, well, there's plenty of bridges in Brooklyn. The reality is that while you may not see a line item on your tax return where you have to pay part of your taxes to cover the banks, you're going to see it indirectly in the form of a variety of costs. This is the thing that always amazes me, is that I don't think the folks in government really understand that, like, when you tell a business, oh, you can't do that, you can't impose that fee, or you can't push that cost onto consumer, that's fine. There's a million other ways to push costs onto consumers, right? I mean, it doesn't matter whether you change the size of the packaging and you can't get a 5-pound bag of sugar anymore, and it's 3 pounds. Okay. Yeah, but we didn't raise the price. Come on. I mean, at the end of the day, we're not so silly as consumers, as Americans, to think that indirectly we won't wind up ultimately footing the bill. So where does that leave you? Well, I think there's a couple of questions from an investment perspective in this landscape that are important to know and to realize. First of all, know what you own. Same thing as know where you're putting your money, which bank you're putting your money in. It's important to know what you own, particularly from an investment perspective. And also know from an investment perspective that what you own is fully accessible at any point in time, meaning that there's full liquidity, full access. So at the end of the day, what does that mean to know what you own? Well, we think it's important that investors have an understanding of exactly what they own down to the detail. Not just, oh, I own a bunch of funds, or oh, I own a bunch of stocks, but really, how does that all shake out in terms of what that picture looks like? Beyond, I've got X% in stocks, Y% in bonds, Z% in cash. What types of companies do I own? Are they small? Are they mid-size? Are they large? What sectors are the companies that I own? What sectors are they in? On the bond side, you can ask the same question. What's the maturity look like of those bonds? What's the credit quality of those bonds look like? We think that's important information to help you as an investor understand what it is that you own. So first and foremost, know what you own. Pretty important stuff when it comes right down to it. At the end of the day, you should be seeing some familiar sort of names in your portfolio, typical types of companies that would have over $1 billion net in sales. So big companies that you would expect to see. And then the other part, to be fully accessible at any point in time, that's really almost a two-part conversation. First of all, you, if you will, to be fully accessible at any point in time. That's kind of important because you don't want to have to wait to the end of the quarter or the end of the year, or whenever somebody lets you actually take money out of the investment that you've made to actually get access to your money, but also on the investment side as well. So it's so important to have that active management to be able to say, okay, we're going to ultimately shift around the positions that you own inside of a particular fund or inside of a particular portfolio, because at the end of the day, if you're just kind of owning purely an index type of an approach, then those holdings aren't going to change. Those holdings are all going to stay exactly the same, and you're not going to get any kind of level of active management. So at the end of the day, those are really kind of the two questions from an investment perspective. Know what you own and know what the accessibility and flexibility is on it that will help you kind of navigate the current environment. When we come back, we're going to talk about ESG investing and Biden's first veto. Coming up next here on the program, Dollars and Cents with Joel Garris of Nelson Financial Planning. So let's talk about ESG investing, Biden's first veto, and how it just becomes another reason why, if you leave your employer, okay, you really want to roll that 401k, that 403b, whatever it might be, over to an opportunity, over to an IRA at the earliest opportunity that you have. Welcome on into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, also one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe and check us out on your favorite media platform, whether it be Spotify, iTunes, YouTube, whatever the case may be. We've got a channel on there just for you. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of certified financial fiduciaries that stand ready this week to help you improve your life with a successful and cost-effective financial plan. So we certainly covered this at length, the ESG side of this discussion, the ESG investing side, about 2 or 3 weeks ago on the program. So I encourage you to kind of check that out. I think we kind of put that up, particularly on our YouTube channel, as with the teaser, if you will, of is ESG DOA. So I don't want to get into all of those kind of details and repeat everything we kind of said on that program, but we do want to sort of pull this all together now that this past week we saw President Biden actually veto this bill that made it through Congress, both houses of Congress, that ultimately was looking to overturn the Department of Labor rule that imposed ESG, environmental social governance requirements, on investments inside of employer retirement plans. So that resolution passed Congress, both houses, presented to the White House. That's how kind of the bill works, right? And then the White House can either veto it or sign it. If they sign it, it becomes law. If they veto it, then Congress has an opportunity to override that veto, which they were unsuccessful at doing. So ultimately, because Biden vetoed the bill, then the Department of Labor rule still stands, which mandates certain considerations of ESG investing inside of employer plans, particularly as it relates to default options and the like. So how does all of that news story, if you will, Congress passes, DOL comes up with a rule, Congress passes a law that says we want to override that rule that the DOL came up with, Department of Labor came up with, and then at the end of the day, it winds up resulting in the first presidential veto of Biden's term. Well, all of that story, if you will, creates, I guess, reason number 5,692 on the list to roll over your employer retirement plan at the earliest opportunity. Why? Because here's the key piece of information in this conversation. This is a Department of Labor rule. The Department of Labor. Not the IRS or anything like that. It's the Department of Labor. So the Department of Labor provides rules for employers to follow. Not just to follow, but they must follow. So if you're not an employer, see where we're going with this? Then the Department of Labor rule doesn't apply. So if you can avoid all of that by simply going to an IRA, an individual retirement account. And at the end of the day, the Department of Labor doesn't have jurisdiction over an IRA. So this rule, Department of Labor, applies to employer plans, be it 401ks, 403bs, or the like. See, that's the beauty of an IRA. The IRA stands for Individual Retirement Account. So not only do you get to pick your own investment options, but because it's outside the Department of Labor jurisdiction, if you will, then you also similarly have unlimited choices. So let's face it, bottom line, as an investor, you want to have the best possible performance. And as an advisor, our side of the equation, if you will, well, that's our fiduciary duty to you. At the end of the day, our fiduciary duty to you, an investor or a client, is to achieve the best possible return that we can achieve. And so if that means we own an energy company, then we own an energy company. And at the end of the day, that's the right decision to make because our charge is to produce investment results. Now, granted, we're not going to, they're going to own a company that's dumping toxins into the groundwater kind of thing. That's silly. But at the end of the day, it does make a pretty good argument for why you don't really want to be subject to the kinds of rules that are coming out in Washington. So we'll make that reason number 5,692 to roll over those employer plan, whether it's a 401k, 403b, whatever the case may be, to an IRA as soon as possible. When is that? Well, as soon as it becomes an option to roll over that balance the second you are off your employer payroll. So whether you leave or retire or whatever the case may be, you then have the opportunity to do that. Similarly, a lot of plans these days, if you're over the age of 59 and a half, will actually give you that opportunity as well, meaning it will allow you the opportunity to do what is known as an in-service rollover distribution. So even though you still working at the company and you're planning on continuing to work there for a while, maybe you're trying to get to 65 to get Medicare health coverage option, then you can still engage in that rollover as an in-service rollover withdrawal as long as you're over 59 and a half. So there's definitely some options, even though, particularly for those closer to retirement, even though you plan on staying with your employer. So those are some of the things to really think about, if you will, on that. And so once again, another reason to continue with this conversation of why it's so important to roll over those old employer plans rather than leave them sitting there. If you leave them sitting there, they're going to be subject to a lot more rules because they are part of an employer plan. So whatever the Department of Labor spits out, those rules are going to apply to the employer plan. At the end of the day, though, they most certainly do not to an IRA, because that, after all, an individual retirement account, well, then that's something that you fully control and have full control over. So important to understand kind of the difference and where this rule applies and where it doesn't. There's certainly plenty of other reasons why you would consider rolling over your employer plan to an IRA, but this becomes just another one in those reasons to do it along the way. Well, that's about it for this week's episode of Dollars and Cents with Joel Garris of Nelson Financial Planning. If you like what you heard and want to learn more about how our team of certified financial fiduciaries can help you change your life with a successful and cost-effective financial plan, visit our website at nelsonfinancialplanning.com or call the office 407-629-6477, and we'll be happy to schedule an absolutely free conversation at your earliest convenience. Thank you for listening to the program this week.